Hello, everyone, and welcome to our Thursday talk. We are this month focusing on the low volatility factor. So most of you must have seen, the volatility that's there in the market currently. Yesterday we had the Fed meeting, and we decided to raise interest rates by 75 basis points, but that was not the surprise. The surprise was that the Fed funds rate, which is their long-term forecast, they've upped that too. That's been a source of added volatility. The rupees had a runaway. RBI trying to hold at 80, but I think that dam is broken now. With that short update on the markets, let's just dive into the low vol factor. So just a very quick recap of what we've looked at earlier. This is the performance of the low vol 50 index versus the high beta index, and we've seen how low volatility stocks generally, on average, outperform high volatility or high beta stocks. Then we looked at why does the low volatility anomaly exist? Why is it not arbitraged away? One effect we explained was the lottery effect, and we'll give you an example today of that. And the agency effect. The lottery effect is basically people buying high volatility stocks or stocks that are in the news in the hopes of getting higher payoff, but the probabilities of that higher payoff are usually lottery like. They're very, very low, and that's why it's called lottery effect. Then we looked at low volatility works at the asset class level. So higher return asset classes also tend to have higher volatility or standard deviation. And we showed that with equities, gold, bond, fixed deposit currencies, and we saw that how here the capital asset pricing model, or the model that gave us beta, works in theory as well as in practice, that high risk assets will tend to give you higher returns. Not in the case of crypto, but at least established asset classes. However, when we look at this relationship intra-asset, that is within equities, it does not work. In fact, it completely goes the other way around. It's not even a flat or linear equation. It's like the complete opposite. It's like high volatility is going to give you lower returns, and low volatility is going to give you higher returns. So that's where we stop. Now let me take you, give you an example. And this is a slide from one of my classes I had done a couple of years ago. So just change of format here. Okay, finance jokes, you guys got it good. Humpty Dumpty sat on a wall, high volatility. So you can see these three stocks in orange, blue, and white, and they've more or less gone in the same direction that period. And I've obviously I've cherry picked these examples, but next week I will show you another example. But this week, let's just look at this one. And you can see the orange one is all over the place, like an excitable. Ralph Wagner gave this example of an excitable dog who's running all around his master, but ultimately, like, it's on a leash and it comes back. The blue one is also close to the white one, but still keeps jumping a little bit more up and down, up and down. Whereas the white one is like the quieter one, it's doing its thing, and in a non-boring fashion, just on its way. But the orange one is like all over the place, all over the place. Ultimately, but from May 2016 to August 2018, it still ends up at the same place, in spite of being up and down a lot more than the white one. Now, let's see what happens after that. As you can see, if you were listening to our post, the one which was the most excitable one or had the highest volatility, the orange one has fallen the most. The second one, which is the blue one, fell about 70%, which is not small. And the white one, which was the boring one, which went about doing its own thing, was pretty much flat. This is through COVID, through the sideways bear market of 2018-19 and all of that. And you can see that if you had just avoided the high volatility one, you would not be in trouble. I'll give you like 10 seconds to just think about which ones of these stocks would be. And then we'll move on, and I'll tell you which stocks these were. So yeah, all the investors and all the traders could not put Humpty Dumpty back again. Yeah, the orange stock still not come back. The blue stock may be okay. The white one is doing pretty okay. So again, no price for guessing. The white one in the previous slide, blue here is HDFC Bank. The second one in the middle was IndusInd, and the last one, the orange one, was Yes Bank. And you can see that, if just on the basis of volatility, you had screened out that stock, you would not be in that trouble today had you, if you bought Yes Bank and you're still holding on to it. What is surprising is that a lot of people bought Yes Bank when it fell 20%, bought it again when it fell 40%, bought it again when it fell another 20%. And then when it finally came to 10 rupees or something, and people said, how much lower can it be? RBI ultimately going to come and rescue it and do this, and banks never fails in India and this and that. What they don't get is that, yeah, all of that may be true in the past, but when a bank gets rescued or taken over, its equity also tends to get wiped out. So the older shareholders get completely diluted. And if you were holding, say, 10 rupee share on the day before the rescue came in, the next day the value of your share would have fallen to 1 rupee. So uh, that's how much when it's at 10 rupees and you ask yourself how much lower can it go, it can go another 100% lower and go to zero. We've seen stocks like that in the past, like Kingfisher and IVRCL Asset Holdings and things like that. But this was just to give you an example. And let's look at the volatility of these three stocks. And this is the 3-year realized volatility. That of HDFC Bank is about 7.8%. The lowest IndusInd Bank 18.6%. Yes Bank a massive 20%. So that it's an important thing that if you're looking at volatility, you may not be able to pick the winner, but at least you can avoid which one is likely to be the loser. Like Charlie Munger says, if I know where I'm going to die, then I'm never going to go there. So, if you know that a highly volatile, highly excitable stock, which is in the news, in the media all the time, not for the right reasons, then you probably is a good idea to stay away from them. But the tendency is always to, go in and buy that one. Today we've taken some stock specific names, so the disclaimer is very important. It's not investment advice, purely for educational purposes. Please consult your investment advisor before investing. Next week we'll show you a case study of a stock which was volatile, relatively more volatile than HDFC Bank, but you can see that when certain things happened, the volatility of that stock sort of went slightly down, and the returns have been far better of that stock. Again, a lot of that is you may say is with hindsight bias, but you can try this at home. Just take the standard deviation formula and do your screening. So thank you. Repeat the disclaimer again. If you want to follow us, you can follow me on Twitter at Anish Bailey at QEDCap. Our website is at qedcap.com. So yeah, like, subscribe, and follow our YouTube channel. And see you again next week. Till then, stay safe.